Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Do you believe that quantitative easing is the main market driver here for stocks shooting higher? A lot of skeptical market analysts do, in fact. We're going to find out how our market timer thinks along those lines. Kevin Cook here with me now. So, everybody is kind of tired of beating the dead QE horse here, but do you have a unique angle on this?
I hope so. Yeah. So, we want to address that central question. Does quantitative easing exist to prop up the stock market?
Right.
I have an opinion. Let me share a more well-researched opinion. This is from Gerard Minack of Morgan Stanley. He put this research together a couple weeks ago, end of February. So he asked the first question: is it the money? And what he's got here is a chart correlating the Fed's balance sheet and the S&P 500, and you can see, it's not a statistical correlation, but he could derive one here, I'm sure. But he's showing the pattern, the relationship, and how they correlate. And one would look at this and say, well, for sure, quantitative easing isn't just correlated. Since it's real money, it must be responsible for this rise in equity prices. And case closed, right? For the cynics.
Right. So the chart speaks for the cynics case,
Yeah.
But is this what they call that spurious correlation?
I don't think it's a spurious correlation. I think there is some connection. But let's look at Minack's second chart, again from Morgan Stanley Research. This one's a little bit more complex, but I'll try and lay it out here. The red line is the forward PE on the S&P 500. The blue line is a sort of an index of macro surprises when economic news is better than expected. So clear correlation here, and this really speaks to the Zacks earnings estimate momentum model, where if analysts are optimistic about the economy going forward, they're going to raise estimates on given companies and sectors, earnings estimates, and that drives stock prices.
Okay.
So this relationship is pretty solid here, and it's consistent with what we believe. The economy drives earnings, which drives stock prices. Core fundamental. So, when you look at it this way, you're like, well, it hasn't been all QE. It's been enough good fundamentals from the economy up to corporate fundamentals and earnings to drive stock prices.
All right, so how do you tie it all together for us? Is there a clear-cut answer between the money and the macro?
I think it's still a blend, but I tend to favor the idea that it's the macro, and quantitative easing is just the necessary medicine. Here's the way I look at it. Our economy was broken in 2008, 2009. So quantitative easing became some necessary medicine for a broken economy to help it get back to self-sustaining. And when I say broken, we're talking about the infrastructure of the economy: banking, housing, jobs, right? So that's the real reason QE exists and will continue to exist. Banking, housing, jobs. Banking's stable, obviously. Housing's coming back. The jobs aren't there yet. And that's why the Fed is, so committed and transparent that they've come out and said, hey, we're going to be here for a long time because this is a big ship to turn around. And that's why they're finally targeting unemployment at 6.5%, and they'll be doing some form of QE probably into 2014. So all these ideas about it ending soon are not realistic. And the pivot here is, is this recovery self-sustaining, and has the economy reached escape velocity, or could we slip back into a recession? Well, we certainly haven't reached escape velocity when we're printing 0% GDP for Q4, and we hope to see 2% for this quarter. So, are we on the verge of recession? I don't think so. But somebody like the Economic Cycle Research Institute, they believe that we have been in a recession since 2011. And as long as we're close, QE has to be there because the alternative is the Japan specter of spiraling deflation. All right, For anybody who's curious about what the Fed is doing on any given day, you can go to the New York Fed website and look at the Permanent Open Market Operations Schedule, for shorthand known as POMO. Now, some traders they're so cynical about this, they think that, when the stock market ramps on a given day, it's because the POMO purchases were bigger. If they average 45 billion a month in treasuries, that's probably an average of 2 billion a day in the market. But some days they do 1 billion, some days they do as much as 5 billion. So you can look at the schedule and see for yourself. And years from now, some report will get leaked by some former investment bank employee that on big POMO days, that's when they could really ramp up the stock market. Who knows? Does it hand the banks extra liquidity and extra profits, that they could turn around and leverage into equities? Sure. But it's not the sole driver of new S&P highs here. So I think anybody with the idea that QE exists to prop up the stock market and is doing so, I think that's a very immature point of view. And you really need to look at all the facts here. All right.
So you actually believe, too, just to clarify here, not trying to be difficult,
No,
but without the Fed's easy money, stock market could still be propelling to all-time highs.
No, I don't. Yeah, so let's clarify that.
Yeah.
Again, QE was necessary medicine to fix this economy. It is still necessary to some degree, because we really did break the economy. Yeah, it was our own fault, but does that mean we should spiral into a depression? No. So does QE help drive fundamentals for the U.S. economy? Yes, which drives earnings. So it does definitely play a factor in the macro picture for the economy, but it's not money that's getting poured into stocks.
Okay.
So that's the difference.
Thanks for clarifying that. Follow Kevin's writings on our website, Zacks.com. A lot of interesting articles, a lot of interesting real-time insights that he posts there. And you can also follow him on Twitter at Kevin B. Cook. With Kevin, I'm Terry Ruffalo.